Good day, fellow investors. There have been many comments for me to analyze Kimberly Clark. And the reason behind that is the recent drop on the Kimberly Clark Kenvue acquisition. So a big company, stable company, paying a good dividend, acquiring a similar company to compete with P&G. If we look at Kenvue, it hasn't been doing that great. So now that the stock is down, they have managed also to, let's say, convince the management to sell it at a premium that seems a premium on the bottom, but it's actually a big discount on where it was trading just a few months ago. And you can see here the situation, creating a 32 billion global health and wellness leader. The goal, what investment banks always focus, is the synergies. So 2.1 billion in synergies. They'll have to first spend 2 billion, 2.5 billion to get to those synergies, fire people like that, but that's how it goes. And creating a new enterprise value, 48 billion, based on the closing price of the stocks on 31 October. That has to be adjusted a little bit. However, when it comes to the acquisition, they are paying 14 times EBITDA, which is on the expensive side of things. However, if they can do the synergies, then we are talking 8 times EBITDA. Perhaps not all the synergies will work, things like that. So 10 to 12 times EBITDA. Okay, one would say. Nevertheless, let's make a little bit of adjustments here. So Kenvue shareholders will receive $3.50 in cash and 0.14625 Kimberly Clark shares for each Kenvue shares. If I make that calculation with the Kimberly Clark share, and the value that one is going to get is 18.71, while Kenvue stock is at 16.166. So that is already just that return going from 16 to 18. Let's say that the deal closes in the next 12 months. Just that is 12% return, all else equal. And you can see here the past year performance on Kenvue was negative. As they combine, then it should do okay. Of course, with these businesses, it is always about scale, so that they can maybe have lower costs, higher margins, get to the synergies, and improve their competitive position. Plus, if we look at the leader there, P&G, if we look at the valuation there on the dividend, on all, then you can immediately have a 2x if all goes well with this merger because of the different valuation. If we look at the business, let me be a little bit philosophical here, it perfectly explains the circle of life. So we have baby and child care, then through life there is a lot of shit going on, and then you come back to the same picture here as you do when baby and child hair. Hopefully the later in life, but that's our inevitable fate after going through a lot of shit. So just a funny note on philosophy, but it summarizes life also from a different perspective. Anyway, their goal is synergies. These are run rate synergies, so 2 billion added to the financials every year on the first estimated costs of 2.5 billion. Let's take a look at the financials. Now, if I look at Kimberly Clark, I see no real growth. Keep in mind, there has been 50% inflation over the last 10 years, and the company is still stuck at 18-20 billion of revenues. So actually, they are not being able to transfer pricing to customers, and they are actually not growing because of that, and therefore we can call this a declining business. Similarly, earnings per share flat also over a decade. They are spending approximately $1 billion now on capital expenditures, and what's left goes into dividends, and here we have a decline in buybacks compared to earlier years. So lower margins, lower money, and things are not that great. Okay, but not as great as P&G, for example. If I look at Kenvue, same story there. Inflation adjusted, declining revenues, net income after the boom that everyone was buying diapers for home. Now we are returned to normalcy. The company spinning off dumps a lot of debt on the spin-off because they can and they do it. They give you a gift, but you see here how they are unlocking the value with this transaction, but there is a lot of that, and all they do is pay a dividend there. So we have the combination there, 45 billion of revenue, 10% net profit margin. That goes from 14 billion to 21 billion because they have 7 and 7 and they need to issue 7 billion of that to pay for that cash. Paying 37 billion, the market cap likely will be around 64 billion going forward. The dividend, 5% of that, and that is also the key risk, because with all the transaction, if there is no synergies immediately, at first it is a cost, that dividend might come under pressure, which is the risk, and which also explains the drop in Kimberly Clark stock. And with the leverage, with the free cash flows going for dividends, the net income, 100% dividend payout, all else equal, there is no room for positive movements there. And that is the key risk with the business, the investment now. Synergies, even if they hit the synergies, that will be used to lower debt over time, especially as both companies were no growth companies. So they cannot just invent growth. And therefore I would say, okay, this is fairly priced for the risk and reward. However, the situation tells me that Kenvue might be a better buy to get to Kimberly Clark, all else equal. You get the 12% plus the dividend, plus the future dividend at Kimberly Clark. So that is already something. Because if I would put Kimberly Clark on the quadrant here, 5% likely long-term return, 5-6, which is the dividend, then you can maybe play around a little bit with the 12% Kenvue situation and get Kimberly Clark when the deal closes in a year. Of course, there is also upside that you get the Procter & Gamble valuation and then you have a 2x. However, if you look at the company, you can see better growth with P&G, earnings also growing with P&G. So things are there, plus they have pushed the buybacks higher, so still doing buybacks, still doing huge dividends. There are also the issues here. You never know when these skeletons might emerge 5-10 years down the road with these businesses. That's also something to keep in mind. So I would say fairly priced, potential dividend, unlikely except for momentum or bets or whatever, unlikely to offer you that upside, that hidden upside. That is what we are always looking for, something that the market didn't recognize. However, in this case, it seems that the market is fairly pricing the situation. So see how it fits you. Think also about Kenvue, see whether you are taxed on that or not. That's it from me. Thanks for watching, and I'll see you in the next video.